webinar. I very much hope that everybody can hear me. We've had one or two issues with the technology this morning, I think it's fair to say, but hopefully everything is working now. If you can't see or hear me, however, please do put a comment in the chat box and we will do the best we can to resolve that. So, good morning. My name is Faye Howard. I'm a private client tax director at Scratton Bland, based in our Ipswich office. And it's my pleasure this morning to welcome you to the latest in our Advisor Live series. Now, Advisor Live is somewhere between a webinar, a podcast, and a training session. It's designed to be as short and as interactive as possible. And we've got quite a few people on the call this morning, so please forgive us, but we've muted your microphones. This isn't because I'm a complete control freak, although I completely am. It's just so that we can keep control of this meeting and get through the points that we think we need to cover. If you do have any questions, however, I am joined this morning by my colleague Graham Doubtfire. He's a private client tax partner in our Colchester office, and he will be responding to any questions that you do have. If I could ask you to direct those questions to the chat box on the right-hand side of your screen. If I see any particular comments, a theme coming up in questions, I will do my best to address those as we go through. But otherwise, we'll address those comments. Graham will answer them during the course of the session, or we will get back to you afterwards. What we're hoping to achieve with these Advisor Live sessions is to provide you with something that's timely, that's relevant, easily digestible, and hopefully also engaging. And to this end, we've set 3 ground rules. We'll be doing these sessions at least weekly, if not more frequently, if events dictate that that's necessary. They will last no more than 30 minutes, and we will keep them as collaborative as possible. So, do ask those questions. We're sort of doing our very best to update you with information as it becomes available, and we will keep you updated. That's the ethos behind these sort of webcasts. We really hope you find this useful, but if you have any feedback at all, please do email us at hello@scruttonbland.co.uk, and we will do our best to take that on board and structure any future sessions accordingly. So what are we looking at today? Well, I wanted to look at some of the tax implications of the measures which have been announced because of this pandemic. So what I've really done is I've split this session into 2 sections. The first section is looking at the measures that we know are in place, because we've got a little bit more meat on the bones of a bit more detail for some of these measures now. And then the second session is really to look at opportunities which may present themselves as a result of the current circumstances. And where I wanted to start is with the Coronavirus Job Retention Scheme. Now, my colleague Luke Morris, our corporate finance partner, did a webinar on this subject a couple of weeks ago now. It was the first of the Advisor Live webinars. But since then, we've had a little bit more information made available to us. We are still expecting the portal for reporting the furloughing information to be available by the end of April. Anybody who knows HMRC in any capacity will realise that it's essentially a huge supertanker, which takes a certain amount of time to get anything done, to change direction. Any sort of measures to be introduced typically take a very long time. So for them to build this portal and have it up and running by the end of April is no mean feat. However, we are told that that's when it will be available. And I'm sure that everybody will have heard the figure of £2,500 per employee, which can be claimed for staff that you put on furlough. And that's £2,500 per employee per month. But in addition to that £2,500, you're also able to claim for employers' national insurance. And that's a maximum of £245, plus the employer's pension contributions. That's a maximum of £59, or based on the 3%, which is the employer's minimum auto-enrolment contribution. The eagle-eyed amongst you will note that £59 isn't 3% of £2,500, and that's because there's around 6,500 allowance before the auto-enrolment pensions kick in, and that's where that figure comes from. So that gives you a total of £2,804 per furloughed employee per month. And this is a grant, it's not a loan, so it does not have to be paid back. When you're accounting for this, it's got to be treated as taxable income. Now, it shouldn't have any effect on your profits because obviously you've got the income element, and then you have to pay out the payments to the staff, the pension, etc. So it should have no effect. And as far as VAT is concerned, it would be outside the scope for VAT. If you are struggling to do this, this is something that we can certainly assist you with. Now is the time to let us know, though, because there are certain authorities which need to be put in place, which can take sort of a week, 10 days to get set up. So if you would like help with this, please do let us know. The other point to make is that a lot of these measures have been introduced really quickly by the government. And I don't think it's unreasonable to assume that there will be a certain amount of abuse of these measures. The power that the government got to introduce the Coronavirus Act, really, to introduce all of these measures, has actually given HMRC an extension of their powers. And what we have seen is that they've said that they will audit these type of claims, not necessarily for every company, but what we typically see with HMRC inquiries is that you get inquiries because there's something on a return which looks a little bit odd, or because HMRC are just looking at one particular area, or you also get them just through the luck of the draw. There are a large number of random inquiries every year. So what we are able to offer is tax investigation fee insurance, where we are preparing these claims for you. And that's a very minimal cost and definitely worth having, and it will cover inquiries into these coronavirus measures as well. So that's for the employees, but what about the self-employed? We've had notification now that there is a grant available for up to 80% of trading profits for the self-employed, again to a maximum of £2,500 per month. However, not everybody is going to qualify for this, unfortunately. In order to qualify, you must have submitted your 2019 tax return. That should have been submitted by the 31st of January. However, if you haven't submitted it yet, you must submit it before the 23rd of April to be able to claim under these measures. You also must have traded in the 2019-20 tax year, and you must be trading or would be trading were it not for the current pandemic. You must also have an intention to continue to trade, and you must have be able to prove that you've lost trading profits due to coronavirus. And you will be asked to submit a certification, essentially, to HMRC to prove that this is the case. Now, unfortunately, this grant isn't going to apply to everybody, because in order to qualify, your self-employed profits must be no more than £50,000, and they must be half of your income for either 2018-19 or for an average of the 16-17, 17-18 and 18-19 tax years. So if your profits are £50,001, you're going to miss out on this. I suppose there is possibly an argument to say that if you're trading at that level, you would probably have incorporated into a limited company, in which case you may be in a slightly better situation, because what you would be able to do there would be able to claim for the salary element of anything you take from that business. But typically that's only going to be about £720 a month, because the balance would typically be dividends. So you would be able to claim as a furloughed employee for 80% of your 720. So you would be slightly better off, but it's not a perfect system, unfortunately, but we would very much hope that these measures would help the vast majority of the self-employed. In terms of the mechanics of this, the government have said that the first payment will be no later than the beginning of June, and the payment will be made as a lump sum for the whole 3-month period into a bank account. Again, this is something we can help with if you need assistance with working out the profits over this period, and we can also offer the fee insurance as well against any future inquiries with HMRC. VAT deferral is quite a useful tool. Now, this applies to any payments of VAT which are due between the 20th of March 2020 and the 30th of June 2020. So typically it's 1/4 VAT. You have to pay that deferred VAT by the 31st of March next year, and there are no interest and penalties. So to me, this is a no-brainer. I really think people should be taking advantage of this. Anybody who listened to my colleague Sarah Healy-Pearce's edition of Advisor Live last week will know that cash very much is king at the moment, and this is essentially an interest-free loan from HMRC. In order to take advantage of this, you don't have to apply for it. It's automatic. What you do is you file your VAT return as normal, but you just simply don't make the VAT payment. If, however, you have a direct debit set up, you will need to cancel that direct debit. If you don't, HMRC will take the VAT automatically. So cancel that direct debit. And of course, don't forget to reinstate it for future quarters. But I wouldn't do that too quickly, because if HMRC try to take it once, they may try again. So I would leave it, a good sort of month or two before reinstating that direct debit payment. Corporation tax. There are no specific measures which have been targeted towards businesses which are having difficulty paying corporation tax. So what HMRC has said is that if you are in this situation, the route to go is to ask for a time to pay arrangement. Now, time to pay is different in that you do actually have to apply for time to pay. It's been around for a long time, and actually it doesn't just apply to corporation tax. Any tax that you are having difficulty paying, particularly as a result of coronavirus, there is a telephone number at the bottom of this slide, and if you call that, explain the situation to HMRC, you can ask them for an arrangement, which is essentially an extension of the time to pay the tax we're talking about. Now, you do have to apply for this. Typically, HMRC will ask for details of the income and expenditure of the business. And in the past, it's maybe been a little bit more difficult to get a time to pay arrangement. However, I would like to think that in the current circumstances, knowing that businesses are under a huge amount of pressure, that it may be a less painful process to apply for this. When we've helped clients get these arrangements in place previously, typically you would be expecting a deferral period of between 3 to 6 months. HMRC want to know the realistic period that you can repay this amount over. And they do charge interest, no penalties, but interest is charged. But that interest rate is just 2.6%. It used to be 2.75%, but with the interest rate cut, it was reduced on the 7th of April. So again, a very cheap source of finance, and certainly something worth considering, I think, at the moment for a lot of people. Self-assessment. Anybody who has got a July 2020 payment on account due, they can defer that payment until the 31st of January next year. So it will fall due with the balancing payment. Again, this is an automatic deferral, no application, no penalties, and no interest. So again, probably a no-brainer. What I would encourage people to do, however, is to file tax returns as soon as possible, because this will do one of two things. Firstly, these payments on account are based on the prior year's profits, so your 2019 profits. If you've got a 31st of March, 5th of April year end, you may find that your profits for the 2020 year you've already started to see the effect of coronavirus in your profits. So the payments on account may have been too high. If we can do your tax return now and get that sent into HMRC, potentially we can make a claim to reduce the payments on account. So the payment on account you would have already made in January 2020, we might be able to get you some money back for that. We can also quantify the July payment on account so you know exactly how much you have to pay by 31st of January next year. And knowing what your liabilities are and knowing when they're due and how they're going to be met should be really helpful at the moment in terms of the cash flow management. So that's the first section of today's session, really, just in terms of measures that have been introduced. But I wanted to talk a little bit about some planning opportunities. And these planning opportunities really arise in connection with capital taxes. inheritance tax planning in particular, and that goes hand in hand with capital gains tax planning. And the reason this sort of came up and has been on the radar is because in my role, I work very closely with a lot of private client lawyers. And from talking to them, I'm sort of hearing an awful lot about how busy they are with updating people's wills and powers of attorney. And inheritance tax planning is something that we typically don't enjoy addressing as individuals because it makes us confront our mortality. And something that's come out of the current situation is that it is making people aware of the need for updating wills and potentially then looking at the planning behind it. And actually, now is a really good time to look at planning because we are in a situation where asset values are suppressed. Whenever we're looking at inheritance tax planning, essentially there are three ways that we can reduce exposure to inheritance tax. The first way is not to die. The second way is to reduce the size of your estate by making gifts, and these gifts are typically gifts into trusts or to other individuals, usually children or grandchildren. And the third way is to change the makeup of the estate, so potentially moving assets from into assets which will qualify for business property relief, for example. Now, of those three options, option number one, not dying, isn't really an option, so we can discount that. And option number three, where we're looking at changing the makeup of the assets of an estate and perhaps looking at business property relief qualifying investments, that's quite a big ask at the moment because these business property relief type investments are essentially funds which have underlying them lots of trading businesses. And as we all know at the moment, trading conditions are challenging, to say the very least. So again, that's possibly not something that a lot of people would want to look at right now. And typically that's something that we would only look at for older clients anyway, because you don't want to be holding that type of investment for too long, because the returns compared to a normal sort of investment portfolio tend to be less. I can't give investment advice, but just sort of talking around the reasons why we would look at these type of investments, timing of doing so. And anybody who has heard me speak or any of my colleagues speak about making gifts will most likely have heard us talk about making gifts into trusts rather than directly to individuals. And the reason that we would typically use gifts to trust if we wanted to reduce the size of an estate is because it allows us access to a relief called holdover relief. So essentially, we can give away an asset that's pregnant with gain, and the gain moves with the asset into the trust. And it either sits within that trust environment for the benefit of the chosen beneficiary, or perhaps after a period of time, the asset may come out of the trust and go directly to that beneficiary. But again, holdover relief has been claimed. And the benefit of that is that the asset goes from the donor to the donee and no capital gains tax has arisen. Typically, assets that we would look at for this type of planning tend to be properties. And we did have some changes to the capital gains tax rules, which came into effect on the 6th of April this year, whereby if you are giving a property where the gain isn't covered in full by relief, so there is some tax to pay on it, that tax has to be paid within 30 days of that property transaction completing. So you make your gift, you've got no proceeds to pay the tax out of, but within 30 days, you have to report that transaction to HMRC and you have to pay the tax. So trusts can be quite useful. However, at the moment, we have a situation where asset values are suppressed. So should we perhaps be looking at our assets and just identifying assets which either the gain has reduced or perhaps they're standing at a loss? Now, something we do have to be mindful of, if we're giving an asset to a connected individual and a loss arises on that gift, that loss can only be used against future gains to the same individual. But having said that, if you're passing assets to your children, you're possibly likely to be using that loss against gains for that same individual anyway. So that may not necessarily be a problem. Capital gains tax at the moment, the rates aren't terribly high. The maximum rate for residential property is 28%, but capital gains tax on any other gain, maximum rate of 20%. So when we're looking at assets, and tying in the capital gains angle with the inheritance tax angle, making those gifts now and possibly crystallizing that gain, paying the tax now, you may actually find that you're shifting more value. If you talk to any investment advisor, they will always tell you that stock market investments are for the longer term. And yes, the market does go up and down, but there are plenty of illustrations that show that, generally speaking, the trend is one of growth, albeit over a longer period. So if we're able to transfer assets now from one generation to another generation, that gets them into the hands of that second generation where the future growth can accrue. And it's dealing with a problem now when asset values are lower, rather than having a bigger problem to deal with slightly further down the line when asset values start to recover. And of course, with the challenging trading conditions we have at the moment, it's very likely that, unfortunately, not all businesses will survive. And if you do have shares in any quoted companies, then it's worth having a look at HM Revenue and Customs website, where they have a list of companies where the shares are deemed to have become of negligible value. So if you have shares in a company where the value has been wiped out, the company's disappeared, gone into liquidation, whatever, you will have a capital loss. And what we can do with capital losses, a general capital loss, we can use it against capital gains of the same year or subsequent years. What we can't do with a bog standard capital loss is carry it back. So where we've got capital losses, it's important really to be aware of those and crystallise them at the earliest opportunity, just to give the greatest scope for making use of those losses in the future. And actually, something else to potentially be considering would be crystallising capital losses now. As I said a few moments ago, talk to any financial advisor, and it's very unlikely that they will advise you to cash in your portfolio and come out of the market entirely. However, what you could potentially look at doing is at coming out of one shareholding in an asset class to crystallise a capital loss and maybe going back into a very similar company in the same sector, just so you've actually crystallised that loss, but you are still in the market. We have to be very careful with shares because there are share allocation rules, and very basically, if you sell a holding of shares and you acquire shares in the same company within the next 30 days, that transaction is treated as though it hasn't actually happened, so you don't get the benefit of that capital loss. So in order to crystallise that loss, to have use of it, you would need to do one of two things. The first thing would be to crystallise it and go into another, invest in another company, possibly a similar company in the same sector, just not the same company. Or an alternative would be to look at something like bed and spousing the shares. Now, bed and spousing isn't going to work in every set of circumstances, but I thought it was just worth mentioning. What bed and spousing is essentially is where one spouse, let's say the husband, sells shares in a company, and then his spouse or civil partner, acquires shares in the same company. Now, I say this isn't going to work in every situation because we do have a rule called the General Anti-Avoidance Rule, the GAR, which is targeted at avoidance, tax avoidance, and sort of contrived arrangements to obtain a tax advantage. And I think if you had one spouse who was very financially savvy, who made all of the investment decisions and had control of the family finances, and you had another spouse who possibly wasn't so up to date on financial matters, didn't have much of an interest, had no control over their own funds, and let's say the husband sold all of his shares in company A, transferred the proceeds to his spouse, and his spouse bought back all of those shares in company A within that next 30-day period, I think that would absolutely be challengeable under GAR. However, if we've got a husband and wife, both of whom have financial independence and have their own opinions, if the husband sells shares in company A and the wife disagrees with that, thinks that's a bad decision, can see potential for growth within that company, and makes their own decision to acquire those shares with her own resources, I think that's a very, very different situation. I'm not saying it would never be challenged under GAR, but if it was, I think there would be a very robust argument there to say that we have two individuals here, each with their own opinions, and actually that transaction only took place because the wife was aware of these shares and actually thought they weren't a bad investment at all and decided to go back in. So potentially one to look at, because what you can do then is essentially crystallize a capital loss, which can be used against any future gains. That wouldn't be restricted because essentially it's a sale to a third party and the wife is acquired from a third party. So we don't have restrictions on that capital loss, but it has allowed us to essentially rebase those shares. Again, I wouldn't want to see a whole portfolio treated in that way, because again, I think that would possibly be much more open to challenge. But if it was a few shareholdings, I think we could have a robust argument to say that actually, the spouse has made their own decision that they want to acquire those shareholdings in their own name. So that's really all I wanted to talk about today. I can see there have been a number of questions that have come up, which Graham has been dealing with. Thank you very much, Graham. We will do our very best to answer anything that hasn't been answered. But, we are regularly posting articles, guidance and updates on our website. And we have a team of people who are dedicated really to bringing you the latest information as and when it becomes available. The best way to access that information is to subscribe to our emails via the website and also have a look at our social media channels. And of course, if you do have any questions, please do email us. I'm very happy for you to email me directly, faye.howard@scruttonbland.co.uk. But we also have the general email address, hello@scruttonbland.co.uk, and our telephone number there as well. So please do get in touch. I very much hope you found this a useful session. And if there's anything that we can help you with, let us know. Okay, thank you very much.